All right. Well, good morning. Looks like folks are getting joined in and getting set up. As we get started, we're grateful to have you join us on our market update this quarter for Q3. Thank you for spending a part of your morning with us. I'm sure if you're on this call, you could probably join me in being grateful for a positive quarter in the financial market. So we're grateful for that as well. Got some good information to share. My name is Cole Pearson, the president of Investment Solutions here at OneAscent. Grateful to have you with us again on these quarterly calls that we offer. As we get started, first, kind of just some housekeeping items. I'll be joined in just a few moments by our Director of Portfolio Strategy, Nathan Willis, who will really get into the guts and the details of our market update. If you have questions for myself or for Nathan at any time during the call, you can email those to info@oneascent.com. Send us an email. You can also use the chat and question functionality built into Zoom, and we'll be monitoring that and hope to get your question answered. If we can't get it answered during the call, we'll certainly get back to you afterwards with a thorough response. This is a quarterly call that we hold every quarter, the third Tuesday of the month, 10 a.m. Central. So please go ahead and mark your calendars, October 17th. We hope to see you there again. So as we get started, we're certainly going to talk about what's going on in the markets, but I wanted to first really harken back to why we're doing this, why we do what we do at OneAscent Investments, and really start, hopefully something on this page resonates with you. When you think about the assets that you have invested, you invest because you're called to do one of these things. That could be providing for your family. It could be educating your children or grandchildren. It could be generosity that the Lord's called you to. Preparing for the future, whatever is next, responding to the unexpected, prioritizing what matters most. One of these things probably resonates as to why you're investing, right? And so at OneAscent, we want to connect the why with the how. Your values inspire why you invest. It's something out in the future, something that you love and care for. We want to posit and suggest that your values can also inspire how you invest. They can be incorporated into the investment process. And that's what we call values-based investing. And this really comes from this belief and this thought that business impacts the world in powerful ways, for-profit business in particular. And so us as investors, we should consider who a business impacts, but also how they're impacting, right? Because of this power. And so that's what we do at OneAscent. We assess how a company interacts with every single person, every square inch. Here on the right, this is the framework that we use to make these decisions. We're looking at the business and how they touch the people and places around them. So that's sort of our framework in terms of how we actually put this into practice. Our approach to values-based investing is 3 E's, 3 things that you can remember. Number 1, we eliminate those companies whose products or practices are causing harm. We take them off of the shelf, take them out of the universe, and we focus our attention and energy elsewhere. And really, that's these last 2 steps. Number two is evaluate. We evaluate companies to make sure they're meeting our investment objectives. The goal of this process is to make sure we're investing in great businesses, great companies that are great investments. But the last step for us with a values-based approach is not simply avoiding harm, but to elevating the companies that are making the world a better place. Because when they're a great investment and they are succeeding, they're growing and adding profitability and adding return to your portfolio, we want the byproduct, the output of what they do, the way they treat their people and the places around them to be a positive, so that it can both grow the financial value, but also grow value for people and places, every single person, every square inch. So to unpack that just a little deeper quickly, eliminate. What do we mean when we talk about products or practices that cause harm? Well, this is what we mean. We seek to avoid profiting from companies whose principal business activities include these things: involvement in abortion, pornography, adult entertainment, tobacco, gambling, human rights violations, predatory lending, alcohol, cannabis, and other severe ethics controversies. We have lots and lots of data and information that we use on a daily, weekly, and monthly basis to help make sure that those types of business lines and practices are the things that we're avoiding in our portfolios. So that's the eliminate piece. But ultimately, what are we looking to invest in? Companies that are worthy of elevating. Because we believe that when a business does well, it can also do good. And so we seek to identify companies that are doing these things. They're elevating flourishing families, quality health care, dignifying vocation, economic advancement, thriving communities. These are the types of businesses and the types of values that the investments in our portfolios espouse. We're looking again for great investments, but also a great business or a great company. So I wanted to start our time this morning with just a reminder of that, of really why and how we do this. We are here for a market update, and so that's the evaluate piece. And so I'm pleased to welcome Nathan Willis, our Director of Portfolio Strategy. Nathan leads our Asset Allocation Committee as well as our Manager Selection Committee, and is excited to have an update for you guys this morning on what's going on in the markets. So Nathan, I'll turn it over to you and welcome you onto the screen.
Good morning, Cole. As I share my screen, I'll just note that I'm thrilled to be here with everybody and lead us through the market discussion. We should see my screen now. So what we're going to cover today in our market discussion is first, we're going to cover what the markets did in the second quarter and how our portfolios performed. We're going to talk through our process. It's very important to have a process, and the markets this year, I think, put a stamp on that a little bit, and we'll go through that process and develop our investment outlook. And then finally, we'll bring it to your portfolio. What actions should I take? What does this mean for me? So let's dig into returns. First of all, you'll see the first line of this chart, the S&P 500 was up 8.7% in the second quarter, a really, really strong return. You can see that mid-cap and small-cap stocks earned money, but less. And international emerging stocks also earned money, but again, less than the U.S. large-cap stock market. And so we had a recovery that continued. This recovery began in the fourth quarter of last year. And it wasn't just a recovery, it's a strong recovery. The S&P is up 17% this year, but it was driven by the large caps. High quality bonds lagged in the second quarter because the Federal Reserve remains committed to further rate hikes. A couple more rate hikes are what's likely. But another dynamic I want to point out is how strong growth stocks have been this year. In the second quarter, growth stocks, expensive, high growth, often technology related, yes, artificial intelligence related stocks were up 12.5% for the quarter and 28% year to date, whereas inexpensive, cheap stocks lagged about 5% for the year. So this growth value divide can also be illustrated by looking at sectors. So let's dig into that. We saw a real interesting dynamic in that through May, returns were concentrated in these AI-driven names. So in communications, that's Meta and Alphabet. In technology, you had Apple, Microsoft, and NVIDIA. And then in consumer discretionary, you have Tesla and Amazon. So those were the 7 AI-driven names that really kind of drove the market this year and were responsible for much of its gains. Everything else was left behind for the first 5 months of the year. We saw something really good in June, though. Every sector contributed and had positive returns. So this is one of the themes that we're going to talk about is the market is broadening out, and that's really healthy for stocks. Year to date, however, it's important to remember that technology dominated returns. So remember, technology, which is up over 40% for the year, is also the biggest sector in the S&P 500. So if you didn't have those big mega cap tech names, the AI-driven names, you were left behind a little bit. So how did our portfolios hold up? Well, we were behind just a little bit for the month, for the quarter rather, and also for the year-to-date period. All of our allocations are here, but what we usually like to do is focus on our moderate allocation, which is our allocation targeted to 60% stocks. And you can see for the second quarter, it was up 2.7 versus its benchmark up 2.8. So it lagged a little bit. And again, about 0.75% behind for the year-to-date period. But it's important to note that the longer term, where we had a more broad stock market, 1, 3, 5, and since inception numbers are all looking really, really good. So it's time to stop and think about how we react to a period where we're underperforming, even if we're only underperforming a little bit. It's really tempting to jump on the bandwagon, right? Assuming that everything will continue the way it has. That can get you in trouble. In fact, I just kind of pointed out 2 behavioral biases that we try to avoid. First one is following the herd, jumping on the bandwagon. And then the second is just continuing or expecting that things will continue the way they've been. And so let's look at how this has played out in the stock market. So investors have extrapolated or might have the tendency to extrapolate these strong technology returns. Technology has kind of left everything else in the dust this year. And this has caused some people to compare the current market to the tech bubble. So let's look at that. We had a similar dynamic beginning in 1999. So we just experienced a 6-month period where tech stocks were up 44%. This, what we're looking at here, is a 15-month period. So all of 1999 and the first 3 months of 2000, tech stocks did a lot more. They doubled. And again, they left everything else in the dust. But what happened after that? For the next 2 years, through the bottom of the tech bust, technology stocks lost 3/4 of their value. So $10,000 in the technology index was worth $2,500 2 years later. And here's the problem with this. We all know there's going to be volatility, but this kind of exceptional volatility is going to cause you to make mistakes. It's going to cause you to make emotional decisions. Even if you owned them on the upside, you might make a bad decision. So let's look at that. If we owned them through 99 and the beginning of 2000, recall we doubled our money, but then we lost 73%. So even at the end of that, we were down 50% in technology stocks, whereas the broad large cap stock market was down about half that, right? So less opportunity to make a bad decision and sell. And the equal weight S&P 500, which is kind of an approximation for mid-cap stocks, was only down 10%. So being diversified really, really helped you from making a bad decision. More importantly, you need to have a process. People might ask now, where are we, relative to the tech bubble? Number one, we're not as expensive and things haven't run up as much, but I can't tell you if we're here at the beginning, if we're here partway through or at the end, right? People ask me, where tech stocks are going to go from here. My solid answer is I don't know. But what I do know is we need to have a good process, right? And we have a process. It's our navigator process. So let's go through this for the next 10 or 15 minutes of the call. As you know, if you've heard our calls before, we have 4 pieces of the puzzle, as it were: the economy, market technicals, sentiment, and stock valuations. So what we're going to do is we're going to start with economy and go around and see how things are and take the temperature. So first of all, as you might expect, the economy is a negative, not a huge negative, but a slight negative. In fact, the economy, if you look at a lot of the data, is perilously close to a recession. So this is the Purchasing Managers Index for the manufacturing sector of the economy. And on here, I have 3 areas which are shaded, and those are recessions. And it's really important to look at when we go into a recession or when we have historically gone into a recession based upon this data. And it's actually right below where we are today. Every time we've gone further into a negative on this measure, we've had a recession. Every time we've bounced from here and improved, we haven't had a recession. So we're really kind of on the cusp of determining whether we're really going to have a recession or whether we may avoid a recession. Another thing to look at is, as I said, we all know there's a recession. Wall Street has been talking about it for a very long time. But when we look at the data, it's interesting to think about how the data is coming in relative to expectations. This chart shows the Citigroup Economic Surprise Index. As you might expect, this shows above 0, the data is coming in better than expected. So it's a positive surprise, right? And below the line of 0, it's worse. So it's a negative surprise. And if you look, almost all of 2023, the data has actually come in better than what was expected. So we know, Wall Street knows, everybody thinks they know we're going to have a recession, but the data is actually telling us it may not be that bad. And one of the other tangible outputs from this data is we've seen earnings estimates kind of begin to recover. I don't have a chart in here for that for the sake of time, but when we kind of wrap up the economy, we've got a recession potentially, but the data is improving and earnings estimates are going up. So let's look at technicals. Technicals we view as pretty positive for a few different reasons. We talked about sectors broadening out, where we saw most, in fact, all sectors make money in June. When we look at the statistics of the stock market, we see the same thing. We look at the advanced decline line, which is just a cumulative number of the number of stocks going up versus the number of stocks going down. And you see that blue line, that's a horizontal line on the bottom chart, shows that that measure really kind of peaked in 2021 and has been below that. So the market has not been broad. And when we see the market going up like it's going up now, we really want to see the market broadening. And fortunately, it's beginning to do that. So we're kind of starting to see a positive, a green shoot, as it were, in terms of market breadth. Also, most stock markets are above their trends. In this chart, I show the S&P 500, large cap stocks, international stocks, and mid and small cap stocks. And then each one of their dotted lines is the 200-day moving average. You see they were all in really negative trends during 2022, but they broke through and have established positive trends in 2023. And that's really good. We obviously want to see them in a positive trend. So it's, again, a sign of health in the market. Lastly, I want to point out one situation which is a potential to be positive, but a kind of a psychological barrier. This is a chart of the S&P 500 technology sector over the last 5 years. In December of 2021, just before Christmas, if I recall correctly, is where it peaked, and it lost a ton of money and gained all of that money back just this last week or two. And so whenever a sector or a market has a tremendous loss and recovers all of that, that kind of becomes a psychological barrier. And when you kind of break through that barrier, which is that horizontal line, if the market continues to go through that, that can actually be a really psychological positive for the market. And so we're looking at this closely to see if we can kind of establish a new baseline for technology. If we have that, that means we feel pretty optimistic about tech, which has driven the market, continuing to be a positive force in the market rather than a negative. So technicals are really good. Breadth has improved. Stocks are on a positive trend, and technology, while it faces near-term resistance, we're watching it really closely. Another green shoot or area we're happy with is sentiment. And I'm just going to show one measure, but I'm going to show it in a little bit of a different way than we normally talk about it. We normally show this as a point in time. This is the number of, or the percent rather, of investors that are bullish minus the percent that are bearish. And we generally like that to be negative, because that means if everyone's bearish or more people are bearish than bullish, that means maybe the selling is done and there's some near-term upside that may happen. However, I've highlighted these 3 areas in red. 2 of them are in the past, and we're coming out of one right now. And these are times where for a long time, 7, 8, 9, 10, even 15 months or so, you've had a lot of negativity in sentiment. And when it comes out of that period of negativity, even though the market's already gone up, there's room for a lot more upside. You see this coming out of the global financial crisis, and you see it coming out of the pandemic. You had 30 or 40% returns pretty solidly for both periods. And so we think this is actually a positive, even though normally the number of bulls being greater than the number of bears is not positive. We think in this period, given that we're coming out of a real big period of negativity, that actually is a positive for the market and bodes well for things going forward. So I don't have a chart for it, but consumer sentiment shows the same dynamic as investor sentiment. We actually hit the all-time lows in the University of Michigan Consumer Sentiment Survey, and it's bounced really, really strongly from there. So both of these we think are pretty positive, or could be positive for the stock market. Lastly, let's talk about valuation. And so we're calling valuation a neutral right now, and let's dig into why. First, we're going to look at a chart that we borrow from JP Morgan. They produce their guide to the markets, and we really like some of the things in there, and this being one of them. So we look at this chart a lot. So there's a lot on here. And first, we're going to look at this line. The line is the forward PE ratio of the S&P 500, and it shows it over the last 25 years. Okay, and if you look at it now, the PE, the forward PE ratio is 19, a little over 19. And the average has been a little bit less than 17. So we're getting to a period of overvaluation. And you see here, you have these 1 standard deviation up line at 20.1, and then 1 standard deviation down line at 13.47. I just want to refresh everybody on what that is. Statistically speaking, that means between these 2 lines, that's 95% of the time. So if you're above that 1 standard deviation, you've got half of 5%. So 2.5% most expensive. So almost all of the instances are below you, or the market is cheaper than it's been if you're above that line. And then when you're below the line, it's the other way around. And so we're not there yet, but we're moving to a point where we're 1 standard deviation overvalued. This is the framework that JP Morgan uses for these 6 indicators right here. And if you look, all of them are overvalued. 2 of them are above 1 standard deviation, or what we might call really overvalued, right? And that's the dividend yield and the price to cash flow. One of these I want to dig into a little bit more because it relates to bonds, though, is the earnings yield spread. And this is in code here on this description, but I want to dig into it a little bit. And it says here the EY minus BAA yield. And what that means is the earnings yield of stocks minus the corporate bond yield. BAA is corporate bonds, just below or just above high yield bonds. And so let's go to the next chart and dig into that a little bit more. So the earnings yield of stocks is represented by this gold line. And you can see here right now, it's right about 5%. And what that means is if you put $100 in the S&P 500, the underlying companies you own are going to earn about $5, right? Now, they're only going to pay $1.50 to you in dividends, right? But they're going to earn $3.50 that they reinvest in as well as the $1.50 they pay you. If you put $100 in corporate bonds today, you're going to earn a little more than that, about 5.7%. Now, if you look at this chart, this is a 5-year chart, but for most of this, the earnings yield of the S&P 500 is above the yield of bonds. And the reason for that is stocks are a lot more volatile, so there needs to be a premium. Now, it's not a huge premium. It's not double premium because equity earnings grow over time, right? We're not going to be happy just earning this 5%. We want it to grow over years. But it's really important to note that stocks have not necessarily gotten a lot more expensive, or their earnings yield has not gotten a lot less, but bonds have become more attractive. And that's really the story on this chart. This story isn't really about the S&P 500. It's actually about bonds. But it's also worth noting that the earnings yield, or the dollars you earn, the underlying companies earn for your $100, for all the other stock markets have actually maintained a little better. So now I'm going to add mid-cap stocks in light blue, international stocks in dark blue, and then emerging markets in that kind of bluish gray. And all of them actually have a pretty good premium, or they're earning more. The underlying companies are earning more for you than the S&P 500. So again, this isn't a story about the S&P 500, but this is a story to say, look, bonds are actually pretty attractive, and other stock markets, mid-cap, international, emerging markets are pretty attractive as well. Lastly, I'm going to give us one kind of entertaining valuation nugget. And so Apple has grown. This summer, there was a real big news story when Apple hit $3 trillion in market cap. It was the first company to ever hit that benchmark, to grow that big. But what I wanted to do was to tie that to the small cap stock market. Apple has actually grown larger than the entire Russell 2000 small cap index. So again, this isn't a story about Apple. Apple may be worth what it's worth going forward. I'm not here to talk about that. But what I am here to say is that small cap stocks represented by the Russell 2000 are about where they were 5 years ago. They haven't really gone anywhere. So maybe rather than chasing the mega cap tech stocks, it's sensible to look at some other areas of the market, small cap, international, emerging markets, like we've talked. So that's my story on valuation. U.S. stocks are expensive, noting that Apple's worth more than all small cap stocks, and bonds are attractive again. So that wraps up our Navigator outlook. But when we're looking at this chart here, you see two that are green, they're really optimistic, and two that are kind of neutral or pessimistic. So we get a lot of mixed signals. And how do you process through that? How do you navigate through the mixed signals that we get? So what I want to do is look at some of the financial press and Wall Street. So let's look at what Wall Street says. This is a chart from Bloomberg, from a Bloomberg article that's linked down at the bottom of this chart. And this shows every year at June 30, what is the gap between the biggest end of year target for the S&P 500 and the lowest end of year target. And you see today in 2023, that gap is almost 50% between the high, which is up something like 15, 20%, and the low, which is down 25% or so. A huge gap between positive and negative targets. So Wall Street doesn't really have a huge conviction on what's going to happen. So let's go to my favorite financial press, which is the Wall Street Journal. Surely they have the answer. So this is from a chart. This is a chart from an article in the Wall Street Journal, and this is their economic forecast. And you can see the chart is from an article that's linked on the bottom of this page. And I kind of, put this in here to poke a little fun at the Wall Street Journal, but also to note that there's a lot of confusion right now. And it's really more important than ever to have this framework that we just went through. So before we talk about what we want to do in our portfolios, let's kind of review the positives and negatives that come out of our Navigator framework right now. First of all, one positive is that the technical indicators are really improving. However, we know higher interest rates are here, and we know from the banking crisis that we haven't really talked about yet, we expect reduced bank lending, right? So this could cause further slowdown, and that might cause stock declines. Second, sentiment is really good, as we talked about, but we haven't experienced a big pullback, right? Our biggest pullback this year in the S&P, I think, was about 7%. And so we know we have pullbacks every year, and we should expect to be tested by volatility. I don't know when. Economic data is improving, as we talked about, but we still expect a slowdown, whether or not we have an actual recession. Finally, attractive returns are available. We talked about bonds, international stocks, and small cap stocks. But expensive large cap valuations, which are what most people focus on and what a lot of psychology is driven by, probably leads us to think the volatility will continue. Finally, we haven't really talked about the Federal Reserve here, but they're nearing the end of their tightening cycle because inflation continues to decline. So that's all really good news. However, they're also committed to reducing their balance sheet. The Fed has been supporting the economy ever since the global financial crisis, and they really ramped up that support during the pandemic. The fact that they're going to reduce that, it reduces liquidity in the banking system and in the financial system, and that has the potential to hurt asset prices. All right, so we looked at Wall Street. We decided that we can't count on them for our process. We reviewed our positives and negatives. Let's look at what other investors are doing before we make some suggestions for you. I thought this was really interesting. It was from a Wall Street Journal article as well. So Vanguard and Fidelity, two huge firms, they interview their clients every year. And so they break that into cohorts. And so they interview people that are just getting ready to retire in Vanguard's case, so people who are 55 years and older. And then in Fidelity's case, they interview people who are just getting into retirement years. And so back in 2011, when they did this survey, these two cohorts of investors, pre-retirees and post-retirees, both had a little bit less than 40% of their portfolios in stocks. These have progressed, and when they did their survey in 2023, there was some drastic changes. Both of these cohorts, so people who are getting ready to retire and people who just retired, have 65 or 70% of their portfolios in stocks. And this was really kind of shocking to me because it kind of goes against the normal rules of diversification. It's reflective of the fact that stocks hadn't really made any money for the last 10 or 12 years. But remember, I pointed out that stock yields are much, much more attractive right now. So what we want to do is tell you to not follow the crowd. What should we do, though? So do manage risk. And what we want to think about is, first, if you own stocks, and to the extent you own stocks, diversify them. Keep some international stocks, some mid and small cap stocks, and some stocks that are not the turbocharged AI expensive stocks. Also, keep your bonds. Bonds are very, very valuable right now. They didn't do well in 2022, but they're positioned really, really well now. Finally, if you're concerned about volatility, you might consider adding alternative assets to your portfolio. So let's look at how this plays out in OneAscent portfolios. Here's a summary of all of our 5 risk-based allocations. And as we normally do, I'm going to focus on our moderate portfolio, our portfolio that's targeted at 60% equity. And as you can see, the first thing I want to say is we're fully invested in both our stock and bond allocations. We are not going to market time, and we don't want you to market time. Stay invested. Second, we're very diversified. You can see we have a lot of allocations in a lot of different areas. We're not just focused on large cap stocks. In fact, right now, you can see 27% in small and mid cap stocks. We have a tactical overweight to both small and mid cap stocks based upon the short-term work we're doing. We won't always have that much of an overweight. In fact, for most of the year, we had an overweight in international markets until just a couple of weeks ago, which really helped us. Finally, we are very broadly diversified in our bond portfolio, including corporate bonds and high yield bonds, more than just government bonds. Bonds that are paying really good yields. We would love for you to talk to your advisor about the right allocation for you. This is the final advice I'm going to give you. Always talk with your advisor about how your allocation needs to change, if it needs to change. But why don't I pass it back to Cole to wrap up our day and see if we have any questions from the calls.
Great. Thanks, Nate. Real quick, if you'd like any information on our investment solutions, on values-based investing, any of the things that you heard about today, all that's available on our website, investments.oneascent.com. You can also email us, info@oneascent.com, and we're happy to share that with you. Just a quick reminder, if you do have any questions, you can use the chat or the question function in Zoom. You can also email those to us, info@oneascent.com. Nate, we've got one here that I won't even filter. It's pretty direct. Are we going into recession? You mentioned that briefly in the negatives piece a moment ago, but I'll pass that question to you. Are we going into a recession?
Well, I studiously avoided answering that, but if I'm forced, here's what I will say. The bond market doesn't think we're going to go into a recession. The spread between treasury bonds, so riskless bonds, and corporate bonds and high yield bonds, which are risky, that spread's actually come down. What that tells us is the bond market's actually not worried about a recession. Then let's look at the companies that rate the bonds. So Moody's, which is one of the big corporate bond ranking services, their projections are that 5% or so of high yield bonds will default in 2024. That compares to 2008 and 2009, when about 13% of corporate high yield bonds defaulted. So the rating agency doesn't expect a significant depression or any kind of a recession that would cause those defaults. But I think another way to answer the question is by highlighting a video I saw this morning on LinkedIn that was trying to answer the same question. And it was a video of 6 guys in a whitewater raft, and they came up, and as you might expect, they came up and they hit a wave, and the raft started to topple over. Well, one of the guys in it grabbed over the side and ended up standing on the top of the raft while it was upside down, and the other 5 rather were in the water, and he stood up and put his arms up. That's kind of maybe how I might describe the economy right now. We've navigated some rapids. We're still on top of the boat, but we've got a couple more things to navigate. So that's not definitive, but I think it may well be that we actually don't have a recession.
All right. Hopefully we're not those 5. We can stay on top of the boat. Let's see. Time for one more question. We'll try to give everybody out on a good time. Nate, you shared a lot of data. This kind of question is asking a little bit for a summation. You shared a lot of data, our 4 different factors and lenses that we look at. What are the 1 or 2 that you keep your eye on the closest right now? We didn't talk much about the Fed this quarter. We didn't talk much about the banking crisis. The war in Ukraine has kind of gotten quiet. So of all the things going on in the world, what are the 1 or 2 things that you watch the closest?
Yeah. So if I were going to just pick one data point, it would be not exactly this one. This is the Institute for Supply Management Purchasing Management Index. They also have another index, which is called the New Orders Index. And that's actually a really, really good leading indicator. And it actually ticked up just a little bit this month. And so if I had to pick one, it would be that, but that's a little bit of a wonky set of data. Another really strong one that I would look at is bond spreads. The spread between high yield bonds and treasuries, which has declined. It's doing pretty well right now. So those are probably the 2 things that I might look at.
Okay, great. Well, we're 10:35. Wanted to be punctual and get you guys back to your day. Again, thank you all for spending part of your morning with us. We appreciate your time and trust and partnership. If you have any questions, please submit those to us. A replay of this call will be made available and should be in your inbox hopefully tomorrow morning. But thank you all again for your time. Have a great rest of your day and a blessed day. We may now sign off the call. Bye-bye.